I expect this panel to be the best of the day. Not just because I'm moderating it, because we have a bunch of wallflowers up here who really hardly say anything controversial at all. So, ground rules for this panel. First of all, pre-money, pound pre-money, you better be tweeting these sound bites. Ground rules are, I don't want anybody agreeing. Like, if you guys agree, you're going to be off the stage. We want contrarian opinions. You don't have to be right, but you do have to be different. So, first off, what the hell is a super angel, micro VC, and are you one or not? Anybody want to take that up and say what?
I'll start.
Yeah.
I think all of these terms are really great, but we have a very unique strategy, and we call ourselves boutique VC because we're really trying to have that custom relationship for every founder that we deal with and we invest in. And at the end of the day, we think it has to reflect organically what the firm does best. And what we think is most important is performance and exits. So we'd rather be the firm with the most exits than micro VC or whatever.
So wait a second. Your advice there is be awesome?
Be awesome, yes.
Be awesome, okay.
Don't be evil, be awesome.
Don't be evil, be awesome.
So there was a time back in 2004, 2005 when we all started as
violently disagrees,
angels.
by the way.
No, it's cute, but I'm actually going to try and answer the question. And the good news is that since McClure is moderating, we can actually get to speak. Because when he's actually on the panel, we have to just shut up. So thanks.
This is true.
So there was a time when we were angels. So we were investing as angels, individual angels, investing our own money. And then some people in the press thought that as active angels, we had bigger wings. And so they called us super angels. And then a few of us, and then a lot of us, raised their first institutional fund, managing other people's money, OPM. And by definition, people said, well, this is a super angel fund. And as we institutionalized ourselves and became larger with teams, people figured out, oh, it's a micro cap VC, so micro VC. At the end of the day, what matters to entrepreneurs is understanding what is the thesis of the investor they talk to, what they're good at, what value they offer, and then figure out how much they should be taking from them.
Yeah, at the risk of going to the penalty box, I'm going to agree as well. This is a title. It's what your name badge says. But what you really care about is not what the person's name is. Who are they? What can they do? How can they help you? So we employ a couple of actors, if you will, that spend full-time, dedicated attention to the earliest stage of investing. But at Google Ventures, we cover a much broader spectrum. In fact, the first deal, the first check we wrote in 2009 was in the tens of millions of dollars. It was only later in our stage and our growth that we deployed some actually look at data and some analysis and decided that placing 60 to 80 bets a year in early stage investments, 100K to 250K per check, was a good strategy as well. And that's where we run into all these guys. We're in fact invested in multiple deals with everybody on this stage.
And I would just say that from my perspective, we're a small fund because we have two partners. And the way both Mike Maples and I look at it is that each of us has to prove out that we are an awesome investor. So it's not just that we're an awesome firm, that each one of us has to be a top 3 to 5% GP, which means to us, we have to be able to each return 3x the investments that we put out.
You have to be a Thunder Lizard VC.
That's right.
All right. Really quickly, before we move on, what's the median check size you write and number of investments per year? So I think we just heard from David Krane, 60 to 80 investments per year.
On the early stage side, and then you'll see us do anywhere between 10 and 20 A and forward.
So maybe excluding the really big check size, what's kind of a median check size for you on the, say, first check?
250K.
250K. Ann?
I'll do about $1 million, $1.5 million.
And how many investments per year?
I will do about somewhere between 4 and 6.
And Mike, the same?
He goes a little bit faster than me.
Okay. Aydin?
So we do about a dozen to 2 dozen, so 12 to 24 investments a year, depending on the cycle. And we are flexible, so we can do anywhere from a couple 100,000 to a couple million.
Okay. Jeff?
We do 5 deals a quarter on average, and our first check is 4 to 500K, and we reserved at least that for follow-ons.
Okay. So the reason I want to ask this question is my observation is, generally speaking, that first round of capital is probably between $500,000 to $1.5 million, maybe up to $2 million. Is that kind of where you guys are maybe a little bit larger. So at the check sizes we're talking about, is it competitive for the folks here on this panel to be in a deal together, or can you fit into those deals? Or do you have sharp elbows trying to get into the same deals? Because that didn't used to be the case when we were all doing angel investing. David perhaps accepted, but
I like to say I have softly rounded elbows. I definitely leave room for other investors, right? And so I've even had cases where, Josh has come back to me and said, oh, I was looking at that company, would really love to be a part of it. And I do my very best to make room for them. I just think that
But wait a second, you're doing a $1 million check and $1.5 million round. Josh wants to write a $750K to $1 million check. How do you squeeze him into that round?
Josh has been known to use some MacGyver moves to make it happen, so I don't want to reveal his secrets.
Okay. Jeff and Aydin, I know you guys used to do a lot of deals with me together when we were all writing 25 to 50K checks. Now you guys are writing 500K to $1 million checks. How many deals have you guys done together in the last year?
I think we're still in a lot of deals, but one of the interesting things that have happened is I think each one of us have kind of graduated and had multiple institutional funds. The most important thing becomes, and some of the LPs before us alluded to this fact, it's very important to have a unique strategy. You can't just replicate what has worked to be a top performer. So one of the things that we did, just to answer your question, is not to be in this situation where we kind of find ourselves in a lot of party rounds. Of course, we work with pretty much every big VC as well as our peers here. But what we instead did is allocate 10 to 15% of our capital to what we call outbound deals. These are companies that don't come to us through deal flow, but we basically find them through our thematic investing and then pursue those. That represents about 40 to 50% of our net asset value. And that means that we don't have to worry about the number of seed firms. We don't have to worry about competition mostly in our size. We don't have to worry as much about the party rounds, but all we have to worry about is be the best, one of the best thinkers, one of the best regarded funds along our thematic focus areas, because we don't like to just make great investments, but we like to call it out on the record. And so far, we seem to have gotten lucky with a few of those. So we hope to continue on that.
So on that note, how do you guys brand and differentiate yourselves, and what do you think you're good at?
So we like to lean in. I think the composition of a first round that a company raises
Sheryl
is
Sandberg
important.
already has that one covered.
She does. We're borrowing it. We hired Sheryl Google, so we.
So wait, when you're saying lean in, does that mean double down on follow-on investment?
Follow-on is common in our portfolio and something we certainly have capital to do. When I first made that reference, my intent was to communicate that we're very hands-on with the entrepreneur. There's 60 people that work at Google Ventures.
The hands-on comment, value-added comment.
It's very true.
Wait, can I do your brand for you?
Please.
We are big geeks and data scientists, and we help you with design, right?
Marketing, recruiting.
No, you're not as
well.
good as marketing as we are, but okay.
Okay. Who's a GV portfolio company? Let's take a spot poll. I mean, the references are very good.
Actually, we've done a lot of deals with you, so that
have?
actually would be representative.
I think we
but
syndicate
aren't you
with
going to
you
say
very
to folks out there, hey, we've got data scientists on our team, we've got designers and UX people, that's our brand differentiation. Google Ventures, we have access to all these big geeks in Google too.
That's exactly right. Thank you, Dave. Well said.
Okay.
That's the pitch. And we deliver it. We've done 200
and by
deals
the way,
in 3.5 years.
We got $1.5 billion, so
That's right.
a lot of money.
That's right.
Jeff?
Discussion we have with founders is why they should let us buy between 5 and 10% of their companies, and it's because of the track record we have in helping build other awesome companies in the portfolio, whether it's in SaaS, whether it's connected devices, Fitbit, I was an investor. There's just a bunch of experience we've had that we can replicate with new companies. What's less obvious is how can I convince a company that does drone fleet management that will be an awesome lead for them, right, which I did two weeks ago. Why? It's because of the resources we can deploy and how great the team is.
So are you going to, when you're trying to talk to entrepreneurs or LPs, are you going to say, hey, here's my 3 big hits? Or are you going to say, here's my 3 areas of specialty?
I think it's both. Those are all our hits. Those are all our promising companies. Those are the reasons why people come to us and want us to take a big chunk of their companies
what
at
if
the
you're
early
just
stage.
lucky at getting big hits?
Well, there's an element of luck in what we do, that's for sure. But you can't sort of be lucky 35 times.
So,
okay.
let me expand on that. We have a counterintuitive approach to differentiation. We think number one, we think differently about this. A lot of the funds and the peers focus on things like percentage owned, value added, and all of that. I think the reason why we call ourselves boutique VC is at the end, we really understand and appreciate the fact that the world's best founders have a lot of leverage, and our best job is to make this a win for them. So our first priority is to make every deal different and to make every deal in a custom way a big win for the founder. That's why we have a small fund size. Paul Graham this morning articulated why our investors so focused about 20% ownership, whatever. So our job is not to fit the buckets, so it makes our life easier with fundraising. That actually comes with performance. But our first priority and the only priority is to make sure that every deal is a win for the founders we work with, and we choose them well. And so I think in that way, we like to differentiate ourselves and make sure that contributes to our brand as well.
And why are you awesome? Why is Floodgate different from all the other folks up here, other than the fact that you're a woman?
Well, that makes me fundamentally more awesome. But
Yeah.
so I would say a couple of things. Number one, I invest in fewer companies than the traditional seed stage investor, and
Okay.
so I'm fairly selective about the companies that I get involved in, which means that I also spend a little bit more time with them.
And are you sitting on boards for all the companies you invest in?
Not all of them, because some of them are in just product building mode, in which case I don't think it really makes sense. But if they're looking at business model and strategy, then that's an appropriate point at which we will form a board. And so I am on several boards. But because I've been selective, I feel like I've created a family of portfolio companies that when a new potential investment comes down our way, they look at our portfolio and they can think about whether or not that's a portfolio that they would want to be a part of. And because we've had some early successes, I think that a lot of people are eager to be a part of that family. I think that the other thing is that it's still unspoken is that this whole early stage investing, micro VC, whatever you want to call it, we're still 5-6 years old as funds. And so to be totally honest, we have no idea if any of us are good at it, right? It's going to take another 5 years to figure it out. And so, I could sit up here and tell you I'm an awesome investor, but I mean, the number of exits that we've had don't really prove that out. It's just still paper money, and we know what happened to paper money in 2000, right? And so I still believe that there's a huge job cut ahead of us for proving out that this model works. I think that having a small fund enables us to prove it out faster and more efficiently, and there's better hope for it because the exits can be smaller and still provide a profit. At the same time, I think no matter which sector you're involved in, you have to have one of the top 3 to 5 companies in a given wave to be really proven out to be a good investor.
And that's why I think that it's very important for us to be much more collaborative as a sub-industry and help each other, to be honest, because it's our game to prove that we're worthy of raising our next funds collectively. And so Josh
we all suck collectively, and we better get better at helping each other not suck very much.
Well, no, it's existence proof, right? Like if you're going to be awesome, you have to show the 3x returns. If you don't have 3x returns, you're not awesome.
But the point I wanted to make is Josh has been exemplary in helping each of us to actually build our franchises when it wasn't sort of his interest because we could be perceived as competitors of first round capital, and we're not. And the whole point is he's been helping us figure out what our specific value add could be, our platforms could be, and he continues doing it, as we've seen with his presentation this morning.
I want to dive into the Series A crunch topic a little bit. So first of all, I guess, do we think there's a Series A crunch or not? Is that a good or bad thing? But probably more importantly, what's your bar for getting involved in a company in terms of either revenue, growth, some other specific metrics? What's the bar for Series A these days? So first off, Series A crunch, yes or no?
Yes.
Yes?
I think there is not only a Series A crunch, but there is kind of a shadow Series A crunch as well, because there are a lot of deals that are convertibles where either new convertibles get added or the convertibles get extended. So I think it's only the tip of the iceberg in terms of the problems. In terms of what we're dealing with, we've been pretty lucky so far to be mostly unscathed from the Series A crunch. But one of the other things that we've done, a lot of times people, and there are a lot of LPs in the room too, just because of our fund size, we get bucketed to seed and early stage investing only, right? I mean, that was the origin for a lot of us. We've actually diverged from that, and we have done some crazy things like co-leading Series C deals or doing mid-stage deals, because what people don't think about, they're all in just simple valuations and stage, but I think the thing that's most important is what is kind of ahead of the firm, and is there still a lot of growth left? In the 90s, with Dell and Microsoft, and then when Google went public, and even before, a lot of times successful companies, people look at it and say, oh my God, that's too good to be true. The growth can't extend like that, but they're not paying attention to the moats of the company, if the company is a leader or not. So I think our job is to find really great companies, and sometimes we get too focused on ownership percentages or rounds or whatever, but the real most important thing is this company a clear leader? Are they really unique? Do they really have a very interesting position that will set them up for future performance?
So
and
you're
growth?
willing to go later stage or early stage to find those winners. Maybe Rovio was an example of something where you really went out of the country, went a little bit later in stage to get involved in a winner.
Yeah, I mean, I don't want to take it out of turn. I think that's the question on, do you invest in Silicon Valley only, or do you go abroad? That's the other thing. I think most of our peers have been mostly focused on Silicon Valley, if not to say in the US. I know Jeff and I are both immigrants, and Jeff also has some international companies. I think our philosophy is our job, first and foremost, is to find the best companies and founders wherever they are. It could be in Nigeria, it could be in Finland, it could be in Canada, it could be in Australia. I think there is this sense, just because we have so many great companies in Silicon Valley, that this is the only place where great companies can be, and we think there could be others. And it's not that easy for investors to jump on a plane and take 3 plane rides just to go visit a company, to do homework. It makes it harder, international law, whatever. But we think that just because we are willing to do that and we hustle more than others, it puts us at an advantage of being able to discover some other great talent that is not necessarily limited to Silicon Valley.
I want to come back to the global question in just a minute, but getting back to Series A crunch, good or bad thing. I guess my perspective on this, to lead the witness a little bit, is there's a lot of noise being made about Series A crunch. I don't think it's a bad thing. I think in general, the quality and caliber of companies is getting better and better. They're getting more efficient at spending their capital. And aside from the fact that maybe a lot of entrepreneurs and a lot of angels might lose some time and money, I don't think we're anywhere near the excesses of 10, 12, 15 years ago. What I think is also the opportunity is because there's a higher caliber of company and a lot more of them coming up. I think, as Paul Graham mentioned earlier this morning, if you're not if you're not a stupid person picking companies, your results should be getting better as well. Yeah. So, what is the bar for you guys in terms of either revenue or some other type of growth? How do you make a decision about jumping into a company? You're seeing a lot more stuff. The quality is probably rising. How do you say yes or no?
I think it's case by case. I don't believe there's a Series A crunch. The Series A deals, the best ones, have never been more competitive, in my view. And there's this new category of options seed companies have, which is this acqui-hire, which I think was created as a result of this, but there is a safe landing that returns most or all capital to investors and gives these guys an interesting opportunity to work on technology behind a larger platform. In terms of what do we look for, what makes the bar, one of the big calculations that we look for is how can we help? How can we affect the outcome of this company? I don't need revenue. I don't need specific numbers of clicks at a certain bar. I want to make sure that if we do something.
Disagreeable here, I would say that we would like to see revenue.
Okay, at Series A?
We would like to see evidence of a business model that makes it obvious there's some way to get to.
That's different than revenue.
We don't typically invest in sort of the rocket, growth pattern where we know there's going to be an opportunity.
We're all investing for financial return. Of course, that's part of our calculus. My offer is that at Series A, that's not critical, but some sense of it and articulation of it. We don't need progress.
Not optimizing for revenue or profit.
That's right. I really want to understand, how can we add value? How can we positively impact the trajectory of this company? If you're a mobile app company and you lean into Android, can I connect you with people at Google that might be able to help you with distribution, with marketing in the Google Play Store? If you're doing something heavily computational, we had a Series A company come to us a few years ago generating 2 petabytes a week of data. They couldn't afford the Amazon bill. We gave them 1 million hours of computation time on the Google Cloud, free of charge. You can't buy that on the Amazon rate card.
So those make sense, but do you invest in iOS companies as well?
The majority of our mobile companies are iOS companies.
What's that?
The majority of our mobile companies build on iOS first. and then go to Android. It's absolutely fine.
So
But you're not making investments based on how much a company needs you. You're still making the investment based on the value that that company is creating.
How much they don't
and
need you is probably a better way to.
Well, the question is clearing the bar. How can you affect that outcome to make sure they clear the bar and don't tip it off the stand? And if we can help them make that jump, that's attractive.
So let me expand on that a little bit. I think we as a firm, there is obviously this desire to invest in Thunder Lizards or Godzillas. Of course, every investor wants to find that. I haven't seen a lot of investors
That's Thunder
actually.
Lizards, not Godzilla.
Thunder lizards.
That's right.
You have
He's
to
just
let
trying
it
to-
roll
Thunder
off your
lizards.
tongue.
So-
He's trying to
Thunder
avoid the
lizard.
copyright
Of course, everybody wants to invest in Thunder Lizards, but I haven't seen investors call out where they're going to find the Thunder Lizards. So one thing that we tried to do is to go one level beyond and said, look, we might miss Snapchats and Instagrams, but we're going to invest in companies that have a critical use case, right? Today, we're investing in companies that do mobile security. We're looking at companies that do that or other things, a lot more enterprise cloud. That's where we think is going to be critical and there's going to be value to be created. That's kind of our bar. The second thing is let's also get another skeleton in the closet out in the room. One of the reasons that we're getting into Series A crunch is on a lot of the boards that we participate, we are uncannily transparent and honest. And what we are seeing is that a lot of board members, in the glory of like trying to grow the company, are not paying attention to the fact that the company is running out of money. So yes, we obviously want to grow the companies and want to make them successful, but let's also make sure that the company doesn't run out of money. So I think there is definitely some scary board practices that we're seeing occasionally. But as far as we're concerned, I think the most important thing, both for Series A and general, is critical use case, as well as lack of competition and how unique the area is. One of the undesired effects of having so many startup companies, in some of the areas the field is too crowded. I mean, I am shocked sometimes by how many companies I see in the same area within weeks of each other, and if anything, we run the hell away from that.
So you brought up an interesting point, which is maybe some differences in alignment and motivations for VCs, particularly different size VCs on a board. When you guys are successful in getting a company maybe to Series B, and you're on the board with those person, they're looking for billion-dollar exits. The size of fund that you have may still mean that a $50 to $150 million exit may be meaningful for you. What happens when founders might optimize for earlier or quicker exits, and the later stage VCs aren't going to make as much money but are wanting to push those guys towards bigger exits?
Look,
how
I
do you
think
deal
at
with that?
the end of the day, that's the founder's decision. Some founders clearly are there to build companies, and it's not even important, I think, to
Are
think
you
of
saying
these
it's
numbers.
the founder's decision and the board doesn't have an influence or
Let
impact?
me
Well,
tell
they
you this.
shouldn't be raising a round from a large VC if they don't have the intention of going
I
big.
think that's the wrong area of focus. I think the single most important thing for the board is, number one, to understand the founder and the motivations and to be supportive. But most
you shouldn't
importantly,
be letting them raise a round
most
from a large
importantly,
VC
most
then.
importantly, again, let me finish my point. Most importantly is to put extra data points for the founder, right? So I think the best thing we can do for the founder is, okay, you're trying to decide if you want to sell the company or raise another round. Let's get a lot more and hopefully better options on the table so that you're able to make the best decision. Maybe the right decision is to build the
Fair
company.
enough, but let's put out a scenario. You guys invest $1 million in a company at, let's say, a $6 to $7 million valuation, maybe $5 to $7 million valuation. The next round is a $10 million round on a $30 million valuation. So it's post-money 40. 6 months after that 10 on 30 round, founder gets an opportunity to exit at $100 million. You okay with that?
To be honest with you, the reason why we have a small fund is we couldn't care less. We have 47 exits, and we had it in less than 5 years. So smaller exits are good. We have some companies that are on an IPO track. That's the reason why we're not, we have one of these companies in each one of our chosen areas. In reality, if the founder's heart is not in it to go take that challenge of building to $1 billion valuation and beyond, it's very, very difficult for the board to force it. In a lot of cases,
Sure
let me be
about
more
that?
specific.
Are you sure about that?
So here, I think what happens is
'Cause the
sometimes,
size-
I'm gonna
sometimes the
violently
founders
disagree
want to
here.
take the exit, but the exit doesn't happen naturally.
But
a
I'm
lot
saying
of times.
the exit is cool for you because you got in at 5, 6, 7 post.
That's what I'm
Yeah.
saying.
The
I don't really
Series
care
B
if it's a
investors
smaller
into the
exit or a
$40
bigger
million
exit.
Then you
post.
shouldn't be selling the larger VCs on the fact that your company is going to go big. You should not allow your founders to go and raise that large round. I think you should have an honest discussion with your founders before you go and raise that kind of round.
So what's the expectation? A founder raises a 10 on 30, post-money 40 round. What's their expectation on minimum exit target?
Hey Dave, here, I think we can go more and more on this, but the
Answer the
reality
question.
is the point that Paul Graham was making earlier this morning, and the reason why we're trying to work out this boutique concept is what the founder really needs is a right size round. Right? There's a lot of these things where because
completely
people
agree.
are
Yeah, but you're
so
skirting the
preoccupied
issue.
about ownership, they say we want to put 10 to 20 million, and then you run into these artificial issues of, oh, now I'm going to need a $200 million exit. The reality is the real value of the company only is determined when there's an M&A transaction or the company goes public. Whatever happens in between is on paper. It's not real. And our job is to essentially improve the options. Another question that would be useful is there are a lot of times when an exit might not realize, and the founder that worked so hard to build this company, sure, there is the insulated glory scenarios of going for the $1 billion exit, but there are a lot of great founders where like the difference is 0 to 1, they get nothing, or they could get this exit that could be 2 to 3x and meaningful.
Go ahead,
And what we try to do.
I'm going to get in here because
No, please don't get in because I'm going to finish the point.
But you've been-
We
you're
try to
high
get
on the
them
stage.
term sheets or other
you
offers so they
definitely
can
had a
realize the
majority of the
exit.
time. You definitely
Okay,
had a
let
majority of
Abs.
the
So
time.
I
on the
would
mic
say
here.
I would make a couple of points here. Number one, if you talk to a VC that has greater than $500 million in their fund size, really what makes a difference for them is an exit that has to be in the
500
multi-billion-dollar range. That's how they make returns for their investors. So it's a disingenuous question to say, well, you just raised a $40 million post. Now, what exit would make your VC happy? It's a $10 billion exit. That's what would make them happy, right? And so
For the Series B, for the lead on the Series B, yes.
yeah. And so
The point I was bringing out was that for that angel or seed round investor, a $100 million exit is probably acceptable for them.
It's
I think
acceptable. It's acceptable,
there's
but
a
you don't make
difference
money.
between acceptable and there's a and what really makes something epic. And I think that if you look at any fund that has epic returns, those funds, whether they're a small fund or a large fund, the returns come from a select number of companies. It's 1 or 2 companies. It's a power law distribution. And to say that all the other small investments and the outcomes really matter in that is not necessarily true. I would challenge you to find a single fund where all the small exits added up to a huge return for that fund.
Power law and asymmetry, yes.
So the whole point is, and Anne is right, if you look at the distribution of exits, yes, we can make money along the way. And that was very true when we were angels, where as long as we were making money on every single deal, we were very happy.
I
As
think
fund
we were all
managers,
happy with the Mint.com exit. I'm not sure that Benchmark
I
was
don't think
happy with
yeah, Benchmark wasn't happy. And we made a mint on this one.
Oh.
The whole point is you will have per fund 3, 4, 5 exits, which will return compounded the multiple of the fund that our LPs expect. So we know that the bar is 3x, 3.5x, 4x net to them, and
Jeff-
you will see
Jeff,
4 or
has
5.
investing in fab.com changed your perspective on what a target win looks like for you?
No.
Oh, come on. Look,
No,
I
because
got to
I-
think you're really happy. First of all, me turned down fab.com because I thought 7 million cap was too high. Kind of a fucked up decision on my part in hindsight.
Don't tell him.
Jeff was in. Jeff's got a piece of $1 billion company. You got to be pretty happy with that.
Well, I'm happy, but we need to sort of continue growing it and building a $10 billion company because
So
that's
now,
what that's what Jason wants to
Do you
build.
have higher expectations or higher targets now for your investments now that you've got something like that in the portfolio?
I'm investing out of a $55 million fund. My target is to return that 4 times minimum, and so I need a few fabs to actually get there. But the point I wanted to just to get back, and I can't believe I have someone impersonating McClure next to me.
That's a compliment?
The point is, if you look at the dynamic of let's go raise a round, and yes, we want to provide 3x, 5x, potentially 10x to that late stage investor, but here is an offer which materializes 6 months later. And if you invest in things like media, so we sold Bleacher Report to Turner, and when I look at the multiple and when I look at the exit, it was an awesome exit for us early investors, but it felt early. The problem is that media outcomes are very discontinued. So there's a bucket of exits around 200, then it's a lot more sort of difficult to get to $500 million, so on and so forth. And for the founders, it's a question of how many more years do I have to wait for that 200 to turn into 500. And after discussion and talking to a bunch of smart people, you decide to take the deal. So I think it's not that you don't want to go for the large exit, it's that reality of what's in front of you makes you think about it twice.
Good.
And as far as we're concerned, early stage investors, very quickly, the cap table alignment makes us side with the founders as opposed to later stage guys.
So can I make one other point? So there was a point earlier made by Hewlett Foundation on the returns. And one of the reasons why the small exits are really important that I disagree with Anne is one of the ways to improve portfolio performance is minimizing losses. Nobody talks about loss ratio and nobody talks about liquidity. Sure, you can get great paper IRR. In fact, we have IRR returns that probably exceed that, but it's only going to be real when these things are really real. And I do agree with Anne only partially in the fact that majority of the returns might come from the big wins in the portfolio, and that's why we try to have as many of them as possible. But I also do think that the small exits are really important because it's a very liquid asset class, and I don't really recall a lot of people talking about liquidity. You're paying a huge premium to get those returns.
So
money is
one of
locked
the
up, and the
things-
returns might come few and far between. But the 47 exits we had happened in an average time frame of 36 months. And sure, they're not the majority of the funds that we have, but it is meaningful to our LPs in the sense that they are seeing liquidity and they are seeing the loss ratio
let me
drastically compressed.
Cut short here and say, I know that you've had an outsized number of returns, and I know you think about exits when you're making investments. That was one of the conversations we've had on a couple of deals together. Was like, you brought up points about where is this company going to be going,
Yeah.
not just are they going to be successful. I want to come back to the global issue just briefly. We have time for maybe a few more comments here. So, David, Google is a global organization. Well, with the exception of maybe China. But
Not without trying.
exactly. But Google Ventures currently does not invest outside the US. Explain the cognitive dissonance there for me.
It frankly started with two reasons. We looked at the data first. You look at the top decile returns in the last 10, 12 years, they come from two geographies. They come from Silicon Valley, they come from Cambridge, Boston area. So we knew we would start there. The data said start there. Additionally, we're still a pretty new fund. We're investing out of our fifth fund. There's 60 people on the team. This is early days, as Ann says as well. If we're going to dilute ourselves and spread ourselves so thin and take a full day being on an airplane,
Dilute or delude? Which?
dilute our time, so limit our effectiveness by sitting on an airplane all day, Wi-Fi
Right.
or not, whether the go-go works or not, it doesn't matter. I'd rather be here running around San Francisco, have my team on the East Coast running around Cambridge and New York, rather than spending time spreading ourselves too thin. We have unique resources internationally. We help our companies go
if you
global.
invest in a company like Baidu, you might, you were actually an investor in Baidu.
That happened. It wasn't us, but it was our LP.
Right.
Indeed.
Exactly. Some might say that was a win that was worth getting on a plane for.
For their calculus, yeah, the corp dev organization is exponentially larger than the venture team at Google. I can tell you that.
So
They have their
I
own
would
plane, too.
encourage you guys to expand that thinking a little bit. I think looking only
It'll
at the
happen.
data of the past, you're not going to find the next Google in the Arabic-speaking
It's
market
inevitable.
or
It's
Spanish-speaking
inevitable. It's just a
market.
function of time.
Right. On the diversity issue, I don't want to make too much of this, but there's been a lot of white guys up on the stage this morning, and there will be more this afternoon. We've gone out of our way to try and make that not be the case, but there's still a lot of white guys in venture capital. I think the acceptable alternative to white guys is Asian women. It seems like there's probably more Asian women in VCs.
That's where
So,
we leave.
Ann, you're sort of the white guy equivalent for a woman in VC.
Oh my God.
When are you going to hire the next sort of, I don't know, black gay VC on your team to increase your diversity opportunities?
Black gay thunder lizard.
Hey, Dave, I think one thing that probably this panel at least would agree
Excuse
is
me,
that
Aydin, is your name Ann?
one thing I would say is I think
You're gonna let him
everybody.
do that? You're gonna I'm gonna let him do that. You got to jump in and grab that if you want.
I'm going to let him interrupt.
Okay.
I was just going to say, I think every group in this panel has pretty good diversity. I'll just speak for myself. We have 6 people. Every single one of us is an immigrant, and we have 4 women out of 6 people. So I think that's pretty sufficient diversity.
So,
As
you
far
know,
as we're concerned.
I actually believe in not hiring. Well, I was going to say not hiring women, but not
Wow,
that way.
leaning backwards.
I believe in not hiring women just because we're women, right? And so I like to believe that Mike hired me because he thought I'd be an awesome investor. And I think that for women to be a part of that dialogue, we have to prove that we can be the top GPs in any firm.
Probably have to prove that you're better.
And so maybe, and I'm up for that challenge, right?
No, but this is a good sign, I think. Jeff and Aydin have both hired women on their teams in the last 2-3 years to invest.
Yep.
You're a full partner at Floodgate. I'd say we are also in that category. My partner, one of my investing partners is women, actually 3 now.
Yeah.
I know Google Ventures also has women on the team. I don't think the venture firms that are innovating have this problem. I think that's been brought up as maybe an issue that there's too many white guys in VC.
I think the main issue has been, I think the counterintuitive part for me was that when Mike and I first got started, we were naturally 50% female. And so as a result of that,
perfect for the San Francisco
it was
LGBT community.
awesome. So for us, what we found that our culture was naturally not male or female in any way, right? So if we wanted to do an offsite, we weren't going to Vegas and hitting the strip bars. We were doing something that was sort of just gender neutral, right? Maybe drinking tea.
Do you think you're missing out on opportunities by not going to these places?
Here we go.
I'm sure I am, but I prefer not to know.
Okay.
Hey,
But
Dave,
I think there's a real important point. The reason why I brought my partner Charles on board is not because of who he is, but because he's absolutely awesome, and he was the first guy I really wanted to bring on board.
For those who are unaware, Charles Hudson is black, I've heard.
Yeah, and I always forget it. You'd be surprised. I was in Virginia doing a fundraising trip, and he said, "Yeah, your partner is very dark." And I'm like, "What do you mean? That is black?" It's like, "Yes." I'm like, "That's why I didn't see him in the bar." Damn.
Wow.
And so
Let
whole point.
me prevent you from putting your foot in your mouth here too
But
much.
the whole point is,
Having been known
the
to do
French
it myself a little bit.
the whole point is that you don't think about that. You think about awesome people joining you.
Yeah.
And I'm super thrilled to have a team
come on,
which
this
is
is
super
such
diverse.
bullshit. Look, I'm going to go on record. We hired women because we wanted women on the team. We hired Spanish speakers, Portuguese speakers, Chinese speakers because we wanted them on the team. There's a perspective they're going to bring that is different from a white guy. I don't care if they're awesome or not. I want them to be awesome, but they're going to see things that we don't see.
Well, I don't. So when Mike actually,
But they have
came
to
me,
be awesome.
No, he hired me because I was at Stanford and I had a unique into Stanford. I was a PhD student. I was uniquely technical, and so those were the attributes that attracted him to me.
You were a Thunder Lizard VC in the making.
I was in the making, and so it just happened to be that I was a woman, and so the advantage to that was in 2008, no one was looking at e-commerce startups, and I happened to like to shop, and so I was looking at e-commerce startups, right?
Who were the buyers online?
And so it was an interesting period to get started in investing and being a woman, and I think it was uniquely advantageous at that moment. I think that you're going to see just a flood of women coming into both investing and entrepreneurship, and I've seen that on the entrepreneurship side.
Already seen
I
it.
get a ton of deal flow from female entrepreneurs, and when I compare that with actually mostly male-dominated VCs, I actually know for a fact that I see many more of the female founders. Now, we still invest with a bar that is extraordinarily high, whether you're female or male, and it's exactly the same bar. And so for me, I look around our portfolio, we have a large number of women. I don't even count them because we have enough, and I know that they're all uniquely awesome.
Hey, Dave,
And
just to
me,
conclude the
that's
point,
what I'm
We're not
I
going to
mean,
have
also-
time for questions here, and we're going to have to cut short. So
just super
30
quickly,
seconds, Aydin.
just to get David
30
involved
seconds.
too. So the reason why we have 6 different people is something that I learned at Google, that I think the diversity of different mindsets and cultural backgrounds really does make for better decision making. And then the second thing is, I do agree with that in one point, that we don't have diversity for diversity's sake, but we have the opportunity to give people a chance to actually play a pivotal role As a result, our CFO was one of like 5 great CFO candidates, but she had somebody hired in front of her at a different firm, and we gave her a chance, and we're really excited that she took a chance to work with us, even though having 15 years of experience. So.
All right, we're going to wrap up on the diversity issue here. One last question. Facebook currently at 24.64, market cap $59.5 billion, almost $60 billion. Quick answers: buy, sell, hold.
Hold.
Hold on. Jeff.
Hold.
Hold. Aydin?
I don't care.
Doesn't care.
I'm a buyer.
Buyer.
Hold.
I'm a buyer. Okay. All right. Thank you, ladies and gentlemen, for a great panel.